In the preceding video, I related how by not exercising patience, I missed being in on a play that would have netted a handsome profit. Now I shall describe an instance where I bided my time and the result of waiting for the psychological moment. In the summer of 1924, wheat had reached a price that I term a pivotal point, so I stepped in with an initial buy order for 5 million bushels. At that time, the wheat market was an extremely large one, so that the execution of an order of this size had no appreciable effect on the price. Let me here indicate that a similar order given in a single stock would have been the equivalent of 50,000 shares. Immediately after the execution of this order, the market became dull for a few days, but it never declined below the pivotal point. The market then started up again and went a few cents higher than on the previous move, from which point it had a natural reaction and remained dull for a few days, after which it resumed its advance. As soon as it pierced the next pivotal point, I gave an order to buy another 5 million bushels. This was executed at an average price of 1.5 cents above the pivotal point, which clearly indicated to me that the market was working itself into a strong position. Why? Because it was much more difficult to accumulate the second 5 million bushels than the first. The ensuing day, instead of the market reacting as it had after the first order, it advanced 3 cents, which is exactly what it should have done if my analysis of the market was correct. From then on, there developed what might be termed a real bull market. By that I mean an extensive movement had begun which I calculated would extend over a period of several months. I did not, however, fully realize the full possibilities which lay ahead. Then when I had a 25 cents per bushel profit, I cashed in and sat back and saw the market advance 20 cents more within a few days. Right then I realized I had made a great mistake. Why had I been afraid of losing something I never really had? I was altogether too anxious to convert a paper profit into actual cash, when I should have been patient and had the courage to play the deal out to the end. I knew that in due time, when the upward trend had reached its pivotal point, I would be given a danger signal in ample time. I therefore decided to re-enter the market and went back at an average of 25 cents higher than that at which I had sold my first commitment. At first, I only had the courage to make one commitment, which represented 50% of what I had originally sold out. However, from there on, I stayed with it until the danger signal gave warning. On January 28, 1925, wheat maize sold at the high price of $2.05 per bushel. On February 11th, it had reacted to $1.77.5. During this all-phenomenal advance in wheat, there was another commodity, rye, which had had an even more spectacular advance than wheat. However, the rye market is a very small one compared to wheat, so that the execution of a comparatively small order to buy would create a decidedly rapid advance. During the above-described operations, I frequently had a large personal commitment in the market, and there were others who had equally as large commitments. One other operator was reputed to have accumulated a line of several million bushels of futures, in addition to many millions of bushels of cash wheat, and in order to help his position in wheat, to have also accumulated large amounts of cash rye. He was also reputed to have used the rye market at times when wheat began to waver by placing orders to buy rye. As stated, the rye market being small and narrow in comparison, the execution of any sizable buying order immediately caused a rapid advance, and its reflection on wheat prices was necessarily very marked. Whenever this method was used, the public would rush in to buy wheat with the result that that commodity sold into new high territory. This procedure went on successfully until the major movement reached its end. During the time wheat was having its reaction, rye had a corresponding way, declining from its high price made on January 28, 1925 of $1.82 to a price of $1.54, being a reaction of 28.25 against a reaction of 28.38 in wheat. On March 2nd, May wheat had recovered to within 3 7/8 cents of its previous high, selling at $2.02, but rye did not recover its decline in the same vigorous way as wheat had, only being able to make a price of $1.70 and 1/8 cent, which was 12 and 1/8 cents below its previous high price. Watching the market closely as I was at that time, I was struck forcibly by the fact that something was wrong, since during all the big bull market, rye had inevitably preceded the advance in wheat. Now, instead of becoming a leader of the grain pit in its advance, it was lagging. Wheat had already recovered most of its entire abnormal reaction, whereas rye failed to do so by about 12 cents per bushel. This action was something entirely new. So I set to work analyzing with a view to ascertaining the reason why rye was not participating in the recovery proportionately to wheat. The reason soon became evident. The public had a great interest in the wheat market, but none in rye. If that was a one-man market, why all of a sudden was he neglecting it? I concluded that he either had no more interest in rye and was out, or was so heavily involved in both markets that he was no longer in a position to make further commitments. I decided then and there that it made no difference whether he was in or out of rye, that eventually the result would be the same market-wise, so I put my theory to test. The last quotation on rye was $1.69 3/4 bid, and having determined to find out the real position in rye, I gave an order to sell 200,000 bushels at the market. When I placed that order, wheat was quoted at $2.02. Before the order was executed, rye had sold off 3 cents per bushel, and 2 minutes after the order was filled, it was back to $1.68 3/4. I discovered by the execution of that order that there were not many orders under the market. However, I was not yet certain what might develop after, so I gave another order to sell 200,000 bushels with the same result. Down it went 3 cents before the order was executed, but after the execution it only rallied 1 cent against the 2 cents previously. I still entertained some doubt as to the correctness of my analysis of the position of the market, so I gave a third order to sell 200,000 bushels with the same result. The market again went down, but this time there was no rally. It kept on going down on its own momentum. That was the tip-off for which I was watching and waiting. If someone held a big position in the wheat market and did not for some reason or other protect the rye market, and what his reason was did not concern me, I felt confident that he would not or could not support the wheat market. So I immediately gave an order to sell 5 million bushels of May wheat at the market. It was sold from $2.01 to $1.99. That night it closed around $1.97 and rye at $1.65. I was glad the last part of my order was completed below $2, because the $2 price was a pivotal point, and the market having broken through that pivotal point, I felt sure of my position. Naturally, I never had any worries about that trade. A short time later, I had an occasion to be in Chicago and asked the man who was in charge of placing my orders how it happened that I received such excellent execution of my first limited order. He informed me that he happened to know there was an order in the market to sell 35 million bushels at the market. That being the case, he realized that no matter how low the market might open, there would be plenty of wheat to sell at the lower opening price after the opening, so he merely waited until the opening range and then put in my order at the market. He stated that, had it not been for my orders reaching the pit as they did, the market would have had a tremendous break from the opening level. The final net result of these transactions showed a profit of over $3 million. This illustrates the value of having a short interest in speculative markets, because the short interests become willing buyers, and those willing buyers act as a much-needed stabilizer in times of panic. Today, operations of this kind are not possible, as the Commodities Exchange Administration limits the size of any one individual's position in the grain market to 2 million bushels, and while there has been no limit placed on anyone's commitment in the stock market, it is equally impossible for any one operator to establish a sizable short position under the existing rules in respect to selling short. I therefore believe the day of the old speculator has gone. His place will be taken in the future by the semi-investor, who, while not able to make such large sums in the market quickly, will be able to make more money over a given period and be able to keep it. I hold the firm belief that the future successful semi-investor will only operate at the psychological time and will eventually realize a much larger percentage out of every minor or major movement than the purely speculative-minded operator ever did.